As global oil prices continue to fall, Moscow is facing renewed pressure with its national currency, the ruble, continuing to fall against the dollar and the euro, putting a further strain on the economy.
Well, I think the dependency of Russia's economy on oil prices continues to be very high, and the progress towards diversifying Russia's economy away from oil and gas has been very limited. I think in part due to the lack of institutional capacity to develop infrastructure and to direct fiscal spending towards areas that would allow for dynamic development of, say, the manufacturing sector of the economy.
Russia's central bank reduced interest rates to 11% from 11.5% in June. It was the fifth, yet the smallest cut this year. The Russian government is facing a challenging task to control inflation.
For Russian government, there are very limited possibilities. First of all, if there will be once again the crisis of the currency market, it will increase interest rate, which is already still high, around 11%. The second thing is some state regulation of the currency flow, foreign capital flow. It might happen so, but there are very few instruments which can be used in such a situation, because there is an absolutely deep, sharp dependence of the oil price on ruble rate.
Almost 25% of Russia's GDP comes from exporting oil and gas. But now the country is facing a fiscal crisis due to a decline in state budget revenues from oil exports and Western sanctions. According to some estimates, every dollar of drop in oil prices costs Russia $1 billion. Oil prices fell down from $114 a barrel last June, representing a potential revenue loss for Moscow of over $50 billion. Lyubova in Moscow, reporting for The Fuse.